Hello, everyone. This is chapter 14, long-term liabilities. So first, let's take a look at the learning objectives of this chapter. First, describe the formal procedures associated with issuing long-term debt. In accounting principles, we discussed or in corporate finance classes, we discussed the formal procedures associated with issuing corporate shares, corporate stock. In this chapter, we will briefly talk about what the procedures are for issuing bonds. For the most part, issuing bonds and issuing shares are pretty much the same procedure-wise. Okay. Second, identify various types of bond issues. 3. Describe the accounting valuation for bonds at date of issuance. So the key here is accounting valuation for bonds, or you can think of it as bond pricing. Okay, this is one of the main topics in this chapter, and we will be focusing on this topic. Number 4, apply the methods of a bond discount and the premium amortization. Okay, so once you have, number 4 is actually based on number 3. In number 3, we discuss the valuation, bond pricing, to be specific. Okay, and once the bond is priced, the difference between the par value and the price is called discount or premium. So if the issuance price is higher than the par value, or the bond price is higher than the par value, that means those bonds are issued at the premium. If bond price is lower than the par value, then the bonds are issued at discount. What is par value? Par value is just like face value of bond. We'll talk about this later. So the key here is amortization. Okay. 5. Describe the accounting for extinguishment of non-current liabilities. This is also quite important. So basically, this is a repurchase or repo. Sometimes people call it repo. Repurchase of bonds issued. You need to be clear here. Here we're talking about early extinguishment of non-current liabilities, meaning the bonds have not matured yet. Okay, companies decide to use cash to buy back those bonds for economic reasons. Usually, this is due to the change of the economic circumstances of the company or the change of the macroeconomic conditions. Number 6, explain the accounting for long-term notes payable. Okay, number 6, explain the accounting for long-term notes payable. We will just briefly talk about this. Okay, remember the main long-term liabilities in chapter 14 is corporate bonds. Long-term notes payable is another type of long-term liabilities, but that is not the main long-term liability in this chapter, so we won't talk about it that much. Number 7, describe the accounting for the fair value option. Fair value option. Okay. We will simply briefly discuss it. If you look at the CPA exam questions, usually questions related to fair value options are very concept-based. So as long as you know the concept, you should be fine. Explain the reporting of balance sheet financing arrangements. So again, this is just about the standards, and we don't plan to spend too much time on this one. Number 9, indicate how to present and analyze long-term debt. Okay. So before we move on to the next slide, which is the slide you are seeing right now. I will prepare the notes. So let me enlarge it a little bit. 16 would be okay. So in chapter 14, the focuses include two topics. First, bond pricing, or what we called in the previous slide, bond valuation. And because of bond pricing, you have a premium or discount. So again, if the price is higher than the par value, then this is a premium. Otherwise, if the price is lower than the par value, then it is discount. Why is it important? Because it is connected to our second main point of this chapter, amortization of premium or discount. Okay, so that is the second main point, and we will be focusing on effective interest rate method. Why do I emphasize it here? Because if you think about what we learned in accounting principles, so we actually briefly talked about the amortization of premium or discount. Okay, depending on where you took it. I mean, when I taught accounting principles, I briefly talked about how to amortize the premium or discount. But in accounting principle, I use a straight line method, which is the easy to apply method. Okay, so in this chapter, we will talk about effective interest rate method, which is actually the method that is tested more heavily in a CPA exam. Okay, so that is the focus of this chapter. Now, let's look at the different types of long-term debt. Again, as I said, this chapter mainly talks about corporate bonds, which is one typical type of long-term debt a company can have. But there, of course, there could be other types of long-term debt as well. And here you see a total of 5 examples, including corporate bonds. So before we proceed to those examples, let's look at the definition of long-term debt. Long-term debt consists of probable future sacrifices of economic benefits arising from present obligations that are not payable within a year or the operating cycle of the company, whichever is longer. So we have bonds payable and we have long-term notes payable. Bonds payable and long-term notes payable, what are the differences between the two? Bonds payable are usually issued to the public, so the bond holders can be large in number. But for long-term notes payable, the debt holder usually is just a few. Okay, typically it is in the form of bank loan. It is in the form of a bank loan. This is especially the case for small firms. Why small firms in particular? That's because not every company has the ability to issue bonds. Because when you issue bonds, of course, you expect that there is a market for your bonds. There will be someone looking for the purchase of your bonds as investments, right? For small companies, it doesn't have a strong reputation. Not many, not many people know about this firm. As a result, it will be very challenging for small firms to go straight to issuing bonds. Instead, they are more likely to go to their own banks and talk with those banks because those banks know more about them. Okay, so there is less information asymmetry. So they are more likely to borrow, when it comes to a long-term debt, they are more likely to borrow from the banks instead of the general public through issuance of bonds. Okay, so this is a long-term notes payable. The mortgage payable, this term is self-explanatory. Pension liabilities and lease liabilities, those two are quite important. Okay, as a matter of fact, we will spend 2 separate chapters talking about those two issues. And those two issues are also heavily tested in CPA exams. So now let's look at this note here in the yellow box. Long-term debt has various covenants or restrictions. What are covenants and restrictions? What is the purpose of covenants and restrictions? The covenants and restrictions are like conditions attached to the bond issuance. And those conditions are in place to protect the interest of bondholders. Why do we need those covenants? Why do we need those restrictions? That is very easy to understand. If you compare bondholders with shareholders, what is the major difference? I mean, of course, there are many differences. So one of the major differences is the power to control or the power to direct. Shareholders can direct the business strategies or business activities of a company through voting power. Shareholders have the voting right. They have the control power. In comparison, bondholders don't. So they cannot control the business activities of a company. How can they protect their own interest if they are not able to directly control the business operation of a company? Through covenants or restrictions attached to the loans or attached to the bonds. One typical example is the restriction on distribution. What is restriction on distribution? Companies make a profit, right? Companies make profit. I mean, sometimes they report the losses as well. Let's just assume that companies make profit. Otherwise, it's very difficult for them to borrow from the general public or borrow from the bank. Okay, so from bondholders' perspective, they want companies to keep the profit instead of distributing those profit to shareholders. Why? The more you distribute now, as dividends, for example, the less you have in future to pay back the liabilities. So of course, creditors or bondholders or banks don't want companies to distribute too much. So what can they do to restrict the distribution? They put it in the form of a covenant attached to the bond or attached to the bank loans. And the covenant may stipulate that the company is not allowed to distribute dividends to a certain amount, or the company is not allowed to distribute more than, let's say, 50% of the profit made in the current year. Okay, so if we put them in notes, first part, let's call it part 1, the basics of bonds. Corporate bond is just one type of many of long-term debt. Okay, let me put it this way. Corporate bond is just one type of long-term debt, and there could be other types. And covenants are in place to protect the interest of bondholders. And bondholders do need those covenants to protect their interest because they don't have controlling rights. Okay. So now let's look at bond issuance. Now let's look at the bond issuance. First of all, bond contract is known as bond indenture. Bond contract is known as bond indenture. On the bond indenture, you have the basic information of bonds. For example, the face value. Remember, we talked about the face value just now, right? Or par value. We talked about it just now. And par value is very important because it is used to determine the interest payment. How much interest do you get in cash as a bondholder? That is determined. That is computed based on face value and interest. What interest? We call it stated interest rate. Okay, stated interest rate is also in bond indenture. Stated rate. We have face value. We have stated interest rate. They are all in bond indenture. And the bond contract represents a promise to pay. To pay what? Very important. First, it is a promise to pay the principal. And second is a promise to pay the interest. So you can think of the payment in two forms. One is principal, and second is interest. Okay, we will come back to this later. You will see. We'll come back to those two types of payment later. Paper certificate, typically a $1,000 face value. So if you look at the corporate bonds out there, usually they're denominated in $1,000 per bond. Okay, again, this is what? Face value, meaning the actual selling price for each bond is more than likely to be different from $1,000. so it is not equal to selling price. Interest payments are usually made semi-annually, meaning twice a year. Okay, twice interest payment a year, usually at the end of it could be at the end of every half a year, or it could be at the beginning of every half a year. It depends on the payment schedule. So when does a company issue bonds? As I told you just now, this is what we call pecking order. Small companies go to bank loans. Large companies go to corporate bonds. Why? Why don't large companies simply use bank loans to meet their capital needs? That is because for large companies, their capital needs are too large for one lender to supply. So that is why those large companies tend to borrow from the general public. Of course, this is on the condition that those large companies have the reputation with the general public, or the information is out there for those large companies. If there is no information about a company, then it will be very difficult for the company to issue bonds to the general public. Okay, and with this being said, so what you see here, used when the amount of capital needed is too large for one lender to supply. With this being said, nowadays there's another type of long-term debt. Okay, and it is getting more and more popular. So here you say that when the company size is very large, it has a large capital need, so one bank cannot provide the liquidity, or what do we say, can provide the bank loan. Then how about a group of banks working together to provide the credit? Yes, this does exist. This does exist widely. That's what I talked about. More popular form of bank loans nowadays. So this is what we call syndicate loans. Okay, so there is a lead bank, but there are many other banks who participate in this loan deal. We call it a deal. Okay, in this loan deal. So each bank shares a part of the whole package, because one single bank cannot provide that much cash, or they simply those single banks don't want to bear all the risks. So this, you can view this as a diversifying strategy from bank's perspective. Okay, so now let's take a look at now let's put those down. So we talked about bond indenture, which is the contract of bonds. Within this contract, we should have information about face value, stated interest rate, maturity date, how many payments a year, so this kind of information. Let's call it the par value, stage the interest rate, or what we call coupon rate. Sometimes it is called coupon rate, and payment, number of payment per year. And okay. By the way, par value is usually in the United States is $1,000 per bond in the US. Okay, so this summarizes what we discussed just now, and Now let's take a look at the common types of bonds. Common types of bonds. There are different types of bonds in practice. Secured and unsecured bonds. Secured and unsecured bonds. Unsecured bonds are also called debenture bonds. So what is the difference between secured and unsecured bonds? Very simple. The key here is, what is the key? Collateral. Collateral. If the bonds are backed by collateral, for example, equipment, building, deposit, okay? If they are backed up by those assets, then we call those bonds secured bonds. Otherwise, they are unsecured bonds. Okay, so we have term bonds, serial bonds. What are term bonds? Term bonds are bond issues that mature on a single date. They are called term bonds. Okay, so all of the examples. Okay, let me see what happened. So this is issuance date, date 0, and this is a maturity date. So you don't in the middle, you only need to make interest. You only need to make interest, and this is principal plus the last interest. Okay, so this is what we call term bonds. Then, what is callable bonds? Oh, I'm sorry. What is serial bonds? What is serial bonds? Bond issues that mature in installments are called serial bonds. What does this mean? What does matures in installments? What does this mean? This means that the principal is not paid at the end totally. Instead, it is distributed throughout the period. So let's call it part of the principal, part of the principal, part of the principal, part of the principal, and part of the principal. Okay, so this is a serial bond. Callable bonds. Callable, I mean, I don't know why the book puts callable bonds along with the term and the serial bonds, but in my opinion, they're totally different. Callable bonds are totally different from term and serial bonds in the sense that callable bonds are about, we call them callable. This is about a feature of bonds. What feature? This feature gives the bond issuer the rights to call and redeem the bonds prior to maturity. Okay, callable bonds. Okay, now we have convertible bonds. So if you think about the callable bonds and the convertible bonds, those two are more like a pair. Callable bonds gives the bond issuer the right to retire the bonds before the maturity date. Convertible bonds give bondholders the right to convert the bonds into common stocks. So clear? Callable bonds, the issuer has the right to make the change, to retire those bonds early. For convertible bonds, the bondholders have the right to make the change. What change? To convert the bonds into shares. So here's the question that I want you to think about when you're at home. Okay. Convertible bonds. For convertible bond holders, when do you think they will exercise the right and convert the bonds into shares? In what kind of situation do you think they will exercise this right? Okay. So, and then we have commodity-backed bonds, deep discount bonds, registered and bearer bonds, income and revenue bonds. For the definitions of those bonds, please take a look at page. Uh, if you're using the current edition, then look at page 765. If you're using other editions, I think it should be around that range as well. Okay, so you do need to know all the types of bonds. So here is an exercise. For the following 4 bonds, which one is a type of bond that the holder can convert into a specified number of common shares of the issuer? So obviously this is a convertible bonds, right? It gives the bondholder the right to make the change. How about the callable bond? Callable bond gives the bond issuer the right to make the change. What change? To retire those bonds. Serial bonds is about when the principal matures. So it matures throughout the period instead of completely at the end. Debenture bond. What is debenture bond? Look at here. Debenture bond are unsecured bonds. Debenture bonds are unsecured bonds. So it has nothing to do with debenture bonds has nothing to do with the right of bondholders. It's more about the collateral. So this is about collateral. Specifically, there is no collateral. Serial bonds is about maturity. And callable bonds is issuer has the right to make the change. And convertible bond, the bondholder has the right to make the change. Okay,